Greetings, Dr. Jeffrey Scott here. This is my weekend market update for April 28th, 2024. I'm dealing with a little bit of a head cold. This is what happens when you have grandchildren that go to daycare and spend a lot of time with you. One little illness after another, but it is worth it. My email address is hgsidoc@gmail.com. I welcome all comments, constructive ones especially, either via email, of which I'll respond, or to the remarks section on eBay, where I'll try and keep up with that as well. I titled this week, Stagflation Fears Don't Derail the Rally. Yet, I should have put YET, because that is a concern. When the GDP figures came in light on Thursday and the inflation numbers were hot, that brought back nightmares of a past marketplace, of a slowing economy but growing inflation. It's hard for the Fed to cut rates and stimulate an economy when the interest rates are going up in the real world because of inflation. So let's take a look at what I see in the markets, and I'll give you my thoughts. As always, this is for educational purposes only. Anything I've mentioned should be taken in the spirit of education and not considered investment advice. I'm a doctor and not a broker. So I do have some licenses. I got MDs and board certification, but I have none of the licenses that would allow me to advise you what you should be doing with your personal accounts. I don't know what your trading balance is. I don't know what your risk tolerance is. I don't know what your objectives are. So I'm going to talk in general of what I'm looking at, what makes sense to me. But again, take that in general as education only. I use a lot of different tools. I pay for them all. Some folks have been really generous and created some tools for me, such as Rob Hoffman and Wealth Charts, and you'll see the back half of this presentation. That's what I'll be spending my time in. It's been such a great addition to my trading armamentum. And trading involves risk, and you alone are solely responsible for any investment decisions you make. Now, not trying to tell you to take shortcuts, but I do a 5 to 10 minute version of this video most days. I typically record them late at night the night before. They get posted sometime around 8:30 in the morning. I don't get a list of your names and your email addresses, which is a good thing because I don't keep a mailing list. But if you put your name and your email in there, you'll get notification of when they come out. It's a very short version of this. Doesn't go into nearly the depth and the detail, but gives you a high view of what I'm looking at and what I think the market's going to do. Speaking of the market, what a great week we had for the bulls. You could see that in the yellow are the major indices, and the NASDAQ, where there was a composite up 4.2 or the Q's up 3.9, led. Even small caps participated up 2.7. If you look at the one-day performance, you could see a sea of green, really NASDAQ up 2% and the small caps up 1%, really led on Friday. So a strong week in the markets. And if you look at some of the big numbers, ARC Innovation rebounded, was up 4.9%. Those that watch me on a daily basis know I talked about SARC a little bit as something that was leading, which is short of the ARKK. Well, obviously, if ARKK is up, then SARC got clobbered. IBD 50 ETF is up 5.9. Now, for me, that's a big deal because I trade a lot of IBD type small cap growth stocks or small and moderate cap growth stocks. And so that reflects a lot the IBD 50. Even biotech was a bit positive. And FANG stocks, despite the meta meltdown with earnings, try thinking of a funny thing to say, that's the best I could come up with. FANGs were up 6.4%, so a big week for the FANGs. They're just off their highs. So strong week in the market. So that is the tone that we start this with. All the sectors in the S&P 500 were up, so that's a very bullish start, but it may not stay that way. If we look at my Q Edge tools from Cigar Nandi at superiorprofit.co, powered by Metastock, this is one of my heads-up displays, and on this heads-up display it shows me that on Friday, 8 out of the 11 sectors in the S&P 1500 are up. The laggards, well, not a big surprise. Staples, which has been moving a lot with as defensive play down, as was utilities down, and the other thing down was financials, probably because rates continued to go up, which I thought in the past was good for banks, but apparently it can get too high. Um, Up here, it tells me that on Friday, 73% of the sectors were up, 8 out of 11. 69% of the industry groups were up, and 60% of the stocks were up. Now, this is kind of interesting because this is what Thursday looked like, and you could see Thursday was pretty red. So a big turnaround day on Friday. If you think about Thursday, markets did okay on Wednesday, and then we had the Meta and some other earnings that came out after hours. And then Thursday morning, the GDP came out a little bit light. Some of the inflation numbers a little bit hot, and the market sold off hard, which is reflected here. If we look at, sorry about that, over a period of time, this is so touchy. Gosh, I gotta figure out how to quiet down this mouse. But you could see over a week, all the S&P 1500 sectors were up, 75% of industries were up, and 68% of the stocks were up. But when you look out 10 days, it's 50-50 and worse at a month. So the market was selling off. And this week, if you listen to my video last week, several times I said, probably going to get a bounce, probably going to get a bounce, probably going to get a bounce. Well, heck, if you listen to anybody's video, you heard we're going to get a bounce. We were really oversold, and several of the things that I'll use to show you today really were pointing to a bounce. Well, we got the bounce. Now the question is, how far do we go? Is this going to go to new highs, or is this just a retracement and a downtrend? Right now it's a retracement and a downtrend, but I'll show you some of the things that I'll be looking at in a few minutes. This is the Q Market Breadth tool from Sagar, also powered by Metastock. And what I just wanted to show you is that this is a composite index of the S&P, of the NASDAQ and the NYSE. And the blue triangles are in exuberant markets and an oversold market. And I guess one of the messages here is it can keep getting more oversold. The skull and crossbones is the Hindenburg omen. And you see the Hindenburg omen before every major correction. 1 out of 4 times it fires, or you get a constellation of them firing. It's only a modest pullback, but you don't get a big pullback without the Hindenburg omens. These purple down bars are called the bingo, and the bingo is kind of the opposite of the blue bar, which is the bango. The bingo is an exuberance to the downside, the bingo, and often will occur before a major bottom. So we don't see anything at the end of the week here, so no signals. This here is the 13-week new high, new low on this combined index, and you could see a week ago we were at an area that you always bounce from, which is why I felt so confident I expected a bounce. Now I can break out the NASDAQ and the NYSE on the right. They both have come out of oversold areas. They're both coming into this resistance line, and we'll have to see how it does. More to follow on that. And we could also look at the others, the Dow Jones, the Russell 2000, the NASDAQ 100, the S&P 1500, and the S&P 500. And I like to do that because it gives me a sense of what's actually working or not working in the markets. And then one of my other heads-up displays is the Nick Drendel. Here's his contact stuff here. Dashboard, which is like $50, and it's powered by free data, so it's pretty good. And it just shows me that, first of all, we closed in the upper part of the range, which is bullish. We've taken out the 8-day, and we're right at the 21-day on the Qs and the SPYs and the diamonds. Why is that important? Because the 21-day is below the 50-day, and you might expect resistance here. And then just 1.5% higher is the 50-day, and you'd expect resistance there. So we are at a likely place of resistance and approaching a bigger place of resistance. So if you're looking for this rally to fail, we're getting into that range where we might have some concerns. What else do I see on this? This bothers me down here. Yes, the number of new highs on the NYSE exceeded the new lows. However, we're still triple digit to the downside on the NASDAQ. Market rallies don't come out of new lows. They come out of new highs. So that's a concern. If we look at the one-day change, cannabis, which has been all over the place, it's been down 12% over the last 20 days, 2% over the last couple of months, up. But you could see a broad-based rally. The losers were transports, energy, staples, financials, and healthcare, some of the more perhaps defensive plays that you might see. I really like this. It sits on one of my monitors and excuse me, it gives me a sense during the day of what's working and what's not working. Rates, hard to see here, but yellow is the spider. It flipped up on the week, and so did rates. So rates higher, markets higher. Gosh, that's something I just don't think goes on for a long time, that rates keep going up at the same time as markets go up. Recession in our near future, I think that GDP spooked people on Thursday. But if we look at 10 minus 2, 10 minus 3, the black line is the zero line. After an inversion corrects and gets back above zero is when you see these gray bars, and that's when you get recessions. Why does the gray bar, or why do you cross back above the zero line? Because either the Fed is rapidly cutting the 2, or the 10 is getting higher. Different stories, both bad. And you could see that we have not crossed yet. Now we're getting closer than we were a few months back, but we haven't crossed yet. Down here, this is the 10-3, similar story further away. Here is a Bank of America high yield index option adjusted spread, a measure of credit tightness. Credit tightness occurs during the recession. We don't have a recession, we don't have any credit tightness. And then this is a Fred Philadelphia Diffusion Index for District 3, and it gives you a sense of the economic sustenance, the strength. And you could see that we're above the black line. And although we did peak our little eyes below the minus 20, recessions occur from minus 20. They don't occur when the economy is strong. So I don't think we have a recession in the near future, but stagflation is a pretty nasty thing. Breadth rebounded as stocks gained. Look at this is that 13-week new high, new low applied to the whole market. Last week I showed you intraday it actually touched the zero line here, or the guaranteed reversal line, and it rebounded higher to finish much higher on the week. And stocks above the 200, stocks above the 40, they also rallied a bit as well. Buckets. Now I look at the buckets all the time, and if somebody asks me just by looking at that picture in the middle, are we bullish, are we bearish, are we neutral? We're neutral. This tells me that 56% of the stocks in the S&P 1500 are below the midline of their Bollinger Bands, and 44% are above. A little bit of a maybe leaning bearish, but pretty neutral. This is what bullish looks like, and maybe too much bullish. 90% are green, and over 45% of the stocks were above their Bollinger Bands. When I see that pattern, and that pattern was December 13th, it's almost guaranteed the market's going down the next day or the following day. It just does not stay like that for long. And the same thing happens on the downside. And you could see recently on April 16th, we got so oversold that 90% of the stocks in the S&P 1500 are below the midline, and we had over 30% below their lower Bollinger Band. These are things that I look at extremes. In the middle, they don't help me so much, but at extremes, they're very useful in knowing what the market is likely to do. Are the Hindies fulfilled? Well, we've had Hindenburg-Omen signals on both the NYSE and the NASDAQ, and as I've said before, only 1 out of 4 times that this happens, and I mean the constellation, and you need to be confirmed within 36 days, but only 1 out of 4 times will you get a massive pullback. But you haven't had a massive pullback in the markets without having a Hindenburg Omen. So we've cleared the Hindies. We haven't had a Hindenburg Omen on the NASDAQ with this platform in 3 weeks, and the NYSE is 2 months. But we're not all better yet, because you could see the number of new highs on the NYSE is less than 5%. The number of new lows are controlled. Now the NASDAQ, we still have an issue with new lows. And we're going to talk more about new lows and new highs in a few minutes. So this is a mixed market without an obvious signal. Here is an obvious signal. Last week, not only was it a strong week, but if you look at performance, which is going to be for all these graphs, the vertical, versus different scores. This is ERG. ERG is an HGSI, www.highgrowthstock.com software site that is very much influenced by the legendary Ian Woodward. And HGSI is able to graph ERG, which is EPS rank plus relative strength rank plus group rank. All of them are 0 to 99, similar to what you see in IBD. The max you can then have is 297, and you could see here that as you went to the right with the ERG being higher, for the most part, you had higher performance. Now, I always say throw out the tail and throw out the head because there's so few stocks, the gray line. So if you just look at the meat, there clearly everything did well on the week, but the growth stocks outperformed the lower ERG stocks. If you look at earnings per share rank, not as big a differentiator because everything did well, but high earnings did well, high relative strength did well. The one thing that didn't match up well was group rank, and I think that's because we saw some rotation back into growth from some of the laggards. So growth took over. So I got an email from one of the folks that participated in our market class, so I guess I got excited. Master class on Wednesday night, got excited about the Hindenburg Omen, and asked the question, well, what do you do on the other side? Is there a signal to get back in? So I thought I'd talk a little bit about some of the things that I look at and look for when to go back in. I've said it before, everybody says the same thing. Tops are a process, a bottom can be an event. If we were to open up 500 points on Monday and close up on the day or close to up on the day, that would be a huge reversal and would suggest we might be at a bottom. Hey, we had that on Friday. So, or Thursday rather, with the close Friday and then the takeoff, the close much higher than the open on Thursday and the further gain on Friday. So we might be there. So it's possible, very possible, that we had that bottom. We won't know for a while, but we may look back at Thursday as being that key reversal day. I look for clues, but might be obvious with that high volume reversal day that I just mentioned. So I'm a big fan of canceling. You probably tell that, those who have been listening to me for a long time, although I got canceling bastardized by Ian, who had his own way of canceling, and then from the Gil Moraleses and the Chris Catchers and John Person and Bob Hoffman and others that I follow, I create my own way of doing things. So O'Neill called a reversal day, a weekly upside reversal, usually first dips below the prior week's low, then rallies in heavy trade to close either with a gain or with a much reduced loss. So you're getting a green candle low. A follow-through day starts on day 4. So if Thursday was the reversal day, okay, Friday was day 1, Monday would be day 2, and will we see a reversal off of that, a follow through off of that day? Now, I think there was a potential reversal day the prior week. And this is kind of where it gets hard because there's different days that you might start from. But a follow through day occurs on the 4th day after a reversal attempt. And the NASDAQ or the S&P must deliver a strong gain in volume up from the previous day. And that big gain in rising volume is a follow-through day, which confirms that a new uptrend is underway. Now, typically you're up 1% on higher volume than the prior day, and the claim success rate 70 to 80%. The bottom bullet is probably the most important. It's not the percentage of success. It's just that most major rallies occur following a follow-through day. Bob Hanna published a series of papers in 2008, questioned the success rate and said it was closer to 55. There's also been an argument, should you be 1% up? For a while it was 1.7% up. And in Rob Hanna's work, it didn't matter. So I think everybody's back to, well, not everybody, I'm back to 1%. Then there's technical clues that I'll look for. If the indices are in a decline, I start to look for, are there new highs versus new lows? Are the leaders breaking out and not failing? Ian used to do such a good job of showing all the rallies occurred when the leaders started breaking out before the indices. Ian developed some indicators. I'll mention the bingo and the phoenix. The bongo I had a part on. I use it as my long and short-term trending indicator. And then the high-low jump, which I think Ian developed and I added to it with the oscillator. And then divergences and the standard things like AD lines, MACD, stochastics. So you're looking for a constellation of signals, but typically you get that big volume reversal day, and you go back and you see these things were firing before, which might have got you ready for it and looking for it. There's two things that are related. One's called the Eureka, one's called the Phoenix, and it combines the arms, the AD lines, AD volume, and when it fires, it's a pretty impressive signal. It's only calculated on the indexes. HGSI will calculate it on the NASDAQ and the NYSE, I believe the Amex as well, and if it will never be calculated on a stock. But if you see a Eureka, which is a green line on some of the charts that I might use, it shows you there's a lot of exuberant buying. If you see a green line after a major run, that's probably Alan Greenspan in the background yelling irrational exuberance. The Phoenix is the opposite. If you see it after the market's had a big run and it starts firing a Phoenix, it tells you there's some undercurrent that the market's going down. And I should have put Eureka in here because we're talking about bottoms, not tops, but same story. And if you see a Phoenix after the market's gone down a lot, it's too much exuberance to the downside. The market's going to reverse. So the Phoenix and the Eureka are similar calculations. So I look at those. The bingo is the baby out with the bathwater signal. So many times you'll hear Kramer, somebody goes, yeah, it was such a bad day on Wall Street. They were selling or throwing the baby out with the bathwater. And what that really means is that everything was getting sold, probably some things that didn't need to be sold. So when I see the bingo, I start thinking capitulation. I don't buy on the capitulation. But if I get capitulation with the bingo, and you might get a series of them before you totally bottom, then I start to see the bullish signals like the Eureka, bullish signals like the Kahuna that I like to watch, which is a percent B change greater than 0.24. That's when a bottom is put in. So it's a constellation of things. So this is a chart from TradingView, and it's got a bunch of custom indicators that I use on it. So this magenta here is the Hindenburg-Omen, and this is going back to the end of 21 going into 22. And you could see that the Hindenburg-Omen fired here and fired here, and we know what happened, a big market pullback. So I'm always watching the Hindenburgs on the way up. When they work, but they don't always work. These red lines here are actually the Phoenix. This is the Phoenix on the NASDAQ. And you have a lighter pink line, which is the Phoenix on the NYSE. I can also calculate it on the Amex, but there's no reason to do that. This deeper color is because they were really big numbers. So you had a market here that was very overbought, and it gave some really negative internals suggesting the market was going to roll over. The green dots, which often occur near bottoms, are the Eurekas. All right, don't have the bingo plotted here, unfortunately. Then I like to look at new high, new lows. Now, this is looking at the NYSE, but you could put up NVIDIA, and you'll find that most of the big runs in a stock occur when the markets are strong. So looking at the net highs, look at the net highs minus the net lows. Sorry about that. I should have put one on. And you can look at an understanding of whether there's bullish volume or bearish volume in those indices. And here is the new high, new lows on the NASDAQ, and down here is the NYSE. I might look at percentage of stocks above various moving averages. Um, in orange, we're looking at above the 50, and in blue and white, we're looking at above the 200. And you could see that often when we get above this dashed line, the market starts to reverse. The same thing when we get below the dashed line. So it gives you clues. So there are a number of things that I use. I talk about the bongo all the time, and this is 3 time frames of the bongo on a single daily chart. You have a daily on top, a weekly in the middle, and a monthly. And then this is that high-low oscillator, and when the market's extended, it typically pulls back. So when it extends to the downside, you get green there, it's bullish. And when it goes above that line, it's bearish. So there's a number of things that I look at, but the ultimate would be to see bingos followed by eurekas and a oversold scenario. So some of the things to answer the question that was asked. Big week coming up. And the key here is the FOMC on Wednesday. Are we going to hear higher for longer? Absolutely. Are we going to hear we might have to raise? I sure hope not, because bye-bye market if they say that. And they know that. And this is an election year, so I don't think they want to be too definitive one way or the other. Or are we going to hear we might reduce quantitative tightening? That would actually be positive for the market and not require them to adjust rates. There's still data, got some employment costs. We got the Case-Shiller. We got employment from ADP on Wednesday in the non-government world. ISM, JOLTS. We've got jobless claims on Thursday, and then we got the U.S. employment report on Friday. And after hours on Friday, we got 2 Fed heads speaking. So who needs earnings? You're going to have tons of volatility just based upon that. But over here, you can see we got another major week of earnings coming in. There's 3 or 4 weeks in a row. This is week 2. Amazon, AMD, Lilly, Coca-Cola, Pfizer, and as I say, and can't forget Apple. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So, markets powered higher this week, led by technology-laden NASDAQ and the small caps. We did see volatility on Thursday after some high-profile earnings disappointments, weaker than expected GDP, and higher than expected inflation. For the first time in years, I was hearing on TV the ugly word stagflation. Friday, the markets were calmed as the PCE, although it looked hot in some areas, was not as hot as feared, perhaps giving some breathing room to the Fed. As I said before, Fed meets this week and no one expects any change in policy, rate policy, but be listening closely for the terms rate increase, higher for longer, and quantitative tightening easing. We have seemed to have flipped to a short-term buy signal in the markets while still in a longer-term downtrend. We're also running into resistance. Is a bottom in? Seems to me that a short-term bottom was made, but we still might be going lower. I deployed a bit more cash with this rally, but still have a lot of cash on the side. Few longs, tight stops, take profits quickly, small positions, be nimble, and don't forget, excuse me, cash is a position. And they have announced the next Wealth 365 will be in July. I'll put the link in the box. I think it's like 78 days away. And I hope you sign up using my link, because the only way to let me keep coming back is if I get people to register with my link. And as I said before, I have no mailing list, so that's a little tough to do. All right, so let me close that off and make sure I save it. And let's look at the market. So this is my weekly timing model. And first thing I look at after the market closes on Friday. So 2 parts of it. They're all weekly charts. Got spiders, Qs, diamonds, and Russell. There are 2 components to my timing model. It is very simple. So simple, you can program it everywhere. And frankly, it works. Price, then you have a 30-period weighted moving average, WMA, and you've got a bongo. Since it's a weekly chart, it's a weekly WMA and a weekly bongo. So what do we see here? We see that the spiders remain in a long condition. It takes both a drop below the WMA and a bongo change for you to flip out of a buy. It certainly is a cautious buy, and that's why the yield sign is here. The Qs stuck their nose below the WMA with a red bongo, and they technically went to a sell signal, but they're now back above the WMA, so I put a yield sign. I wouldn't be shorting, I wouldn't be buying. I'd be careful, at least in scale. Little positions here and there, it's a different story. The Russell's at an interesting place. It too is above the WMA with a red bongo, so the yield sign has come up. However, it's also at the top of the box that it was stuck in for a long time. So this is an interesting place. And then the diamonds got the yield sign because they closed above the WMA and the bongo's red. So at least on the weekly charts, we've healed some. Still one green and three that are still considered in sell signal, although the three in sell get a yield. So hopefully, if you're bullish, that means they're going higher. Does not mean that they could go either way. It's just be careful. The short-term ones, interestingly, are red on the spider and the IWM bongos, and both of them are below the WMA. I put a caution because we're getting close on the IWM. If we look at the Qs, technically they're in a sell, and they flipped the bongo, but so I put a green here because they're getting close to flipping on the daily. And I put the yield there, and the same thing on the diamonds. They're below the WMA. They flipped on the bongo, so they get a yield sign. So much better than last week when everything was pretty negative. But I think this is a market that could still go either way, and a further run up into resistance and failure is probably where I put my bet. But hey, I don't bet my retirement account. I sit on my lap, and I make investment decisions based upon what the market does, not based upon what I'm thinking it does on Saturday. All right, let's take a look at some other things while you're here. Let's go look at the indices, and let's take a look at the week we just had, and let's look at the 5 minutes. So last week was a tough week. Everybody who I talked to, hear from, even had played some cards with my friend John Person on Sunday. We talked about how the market was going to bounce. I think he prefaced it by asking me 200 or 300, and I looked and he goes, how much do you think the Dow was going to open by? And he was right, and we did see the big move up. Again, I think most of the market pundits that I ever come across said we were going to bounce. And that's because if you look at where we were, it's like a ski slope. So we bounced a little bit on Monday, retraced, and then Tuesday, rest of Monday, Tuesday, great sessions. Wednesday, kind of flat, waiting for FANG earnings and waiting for data. Thursday, we did not like either of those. The market dropped. But here you go, you got your reversal. The problem was it was not a reversal on big volume. You got a reversal closing, filling the gap, pretty much getting close to filling the gap by the time the market closed. And then we gapped through the gap and traded higher on Friday. So if you look at where the week started, what a great week. This was the prior week close, so you know you're up on the week, and we already talked about that. So if we look at the daily charts, first thing I look is the weekly bongos are red on all the major indices. That's important because that tells me that the intermediate trend is down. In fact, all of these look like they're in downtrends. Now, I thought the spider had run up, pegged the 50, and come back. Well, it could peg the 50 as early as Monday. It didn't even come down to the 38.2% retracement. Another thing that I'll look for finding bottoms is looking for the targets, which might be the Fibonacci, big Fibonacci number. So, nice move on the spider on Friday, up 0.95, but still in a downtrend and still has to get above that 50. The Qs, right up close to the 50. I think both of them are at the 21-day or at the 20-day, so they could fail right here. But it has a little bit move into that 50, which I think would be an area of concern on the Qs. And, you know, like the spider, it had a nice day on Friday and was up 1.54%. The diamonds, same story, up 0.36 and have to get above that 50. So that 50 and the 20-day as well are two potential sites of resistance. The IWM not only does it have the 50, but it's also got this line here from the prior Darvis box it's going to have to get above. So all of these are areas where if we're going to reverse, we're going to see that reverse. Um, doesn't mean we're going to reverse. We could certainly bounce and take out all-time highs, and you got to be ready for that. But I do think that reversal is something to be watching. And I'll show you some of the reasons why. Volatility, like the week, and if we look at the VIX weekly, make sure it's up. It shows you it was down 20%. Market rallies, volatility goes down. And we can see here that the 10-year is basically going sideways in a major uptrend. If the 10-year breaks higher, I think that market's in trouble. If the 10-year breaks lower, probably means the economy's in trouble and the Fed's going to start thinking about cutting. But I think the dollar matters here. If we look at commodities, small gains on gold 0.32 and loss on silver 0.68, and they both had major runs. I mean, that strong dollar is going to bother them as well. Oil eased a little bit being the key word, 0.06 after a big move on Thursday. Notice on gold, silver, and oil, and the 10-year, the weekly bongo, which to me is the main trend thing that I look at, trend indicator, are all uptrends. Natural gas has been dead for a long time. Now the 10-year, like the dollar, is in a pretty significant uptrend. Now it's up near the highs. Now, if this breaks through and continues to go higher, like the dollar, this will be very damaging for the market. And we'll see how we get through the Fed day. But I am worried about the 10-year and the dollar as being reasons why this market is potentially carries some risk here. Here is a new 10-year, I guess, colon SME that is a symbol in Trey and Tasty, replacing the TNX, which I couldn't get to work. All right. Then I would look at my hourly sectors, and I looked at them a lot today, and there's just no story here. There was a broad-based rally. There's not some doing much better than others. Sure. What's the weakest? So again, I look at two things. I look at things that are pointing near the bottom as showing longer-term weakness. Biotech is weak. Now, XLV, it's off the bottom. Discretionary is off the bottom. Utility was strong, but actually weakened a little bit on Friday. Real estate remains weak. Staples was strong, weakened on Friday. Technology has been weak, gained some on Friday. Industrials strong, weakened a little bit on Friday. Financials weakened a little bit on Friday. Energy weakened. Communications has been weak but strengthened on Friday, and materials weakened a bit. How could they be strengthening and weakening? I know most of them, if not all of them, were up on Friday. However, I'm looking at relative performance compared to the S&P 500. So if they all perform close to the S&P 500, they'd all return to the middle of the scale. So the long red line tells me recent weakness, and the presence of where something is sitting, like biotech way down the lower right-hand corner, tells me longer term weakness. So I don't get a big signal out of this one. I'll go to stock scanners, and we're going to go to the heat map, and we're going to start here with the NASDAQ 100. Now, it was a strong market this week. It was a strong market on Friday, and when I first saw that, I was like, how is this possible? And then I remembered something about the data provider for wealth charts. We know Google had a big day on Friday. Why is it showing red? Because the after hours move, which was significant, was counted on Thursday, not on Friday. So I'm just going to ignore these because it looks like this is weak, yet we know Google had a massive gain. You can see right here, Google was up 10%, yet it's showing here minus 4%. What does that mean? It must have meant it was up 15% after hours and closed the week up 10, so it gave up 5%. So we're not going to look at those because of the impact of earnings. But wealth scanner is still bothersome. And if I saw a lot of strength here, it would be another signal that might push me to want to go long in this market. And it's running its test right now. Remember, this is top-down ETFs are indexes, sectors, industry groups, themes. And I look to see countries I look to see what comes up to the top, and I might want to focus what I look at those things that come up to the top. Well, first I look at there's nothing above 850 or at 850. There's nothing above 800. So generally there's nothing that's a big standout. If I look at the bearish side, let it run its thing, and flip it, I see the weak leaders are transports, Saudis, transports, Indonesia, biotech, muni bonds, healthcare. All right. I can tell you since Wednesday there's been improvement here as a lot of things have eased off that bottom. Let's go back to the bullish scan. And if I had to dive in and see anything I liked, once I get through the first couple, we'll let it do its thing. I don't know to a Singapore, but you still have silver. Nice pullback setting up to go again. Gold miners, looks like silver. MLPs, and there's staples, which was strong, gave it up, and looks like it might be coming back down, and copper has been really strong as well. So miners. Now, I'm not sure I'm going to find any great picks on my pullbacks and uptrends here, but let's take a look. So let's go into CAT Scanner, and let's first look at miners. I think I've got one called miners. If not, I've got one gold and silver. Metals and mining. And what comes up to the top, and this must have been an earnings play, and I'm happy to announce that the earnings signal is back in wealth charts. And here it is. Tells me that they came in as expected. All right. Whatever, the market loved it. Look at the volume. Look at the big gain. I thought might have been a split when I saw it the first time. This is SLCA, US Silica. It's a big move. I don't usually chase something, even though if the Bible gap up, it means it can go higher. But the high jumps at 100. Look at the relative strength in OBV. Did great. It's the kind of thing I expect to ease a couple days, set up a flag to go higher. Alcoa. So this is what I expect that one to do. A big move up, a little bit of a flag, and breaking out on Friday with a breakout momentum. Flip the bongo. Relative strength and OBV are setting up, not extended. I like Alcoa. Sandstorm Gold is another one that's a cheap stock. Run up, pull back, and breaking out here. So there's a couple of things that look interesting. Energy had been holding up. So let's see if there's anything in the energy ETF. I'm not sure if the other one includes the MLPs. Let's see if I got it. So what comes to the top? Bloom Energy, they are engineering and I think solar. A lot of talk about whether solar is improving. YPF is I believe, an integrated energy from South America. Not that exciting. All right. What about Staples? They had did really well last week. We don't like Staples in the lead because Staples mean the market's probably doing poor. And number 3 is Colgate-Palmolive. And again, big move up, closed right in the middle of the day, right where it opened, and it had a 13% earnings surprise. So unlike some of the others, it's not extended, just not the kind of stock I usually play. Sprouts Farmers Market, we liked last week, still like it this week. Here's what we got last week, and big move. Didn't do much right away, and now looks like it's going. But look at all the volume that came into SFM last week, and coming out of a squeeze, relative strength and OBV not extended. Something's going on. I don't know if somebody's accumulating it, if somebody's secretly buying it. I have no idea. I'm just saying that. But boy, that's a lot of volume coming in on kind of like stalling days if that was a market. I can broaden this and I can look at, let's look at Chinese stocks because I heard some talks about that. Let's be objective. I don't know anything about ASHR, but I do know that JD is one that I liked a lot. So JD is, I think it's kind of like a Chinese Amazon, if I'm correct. I think that's Baba, but I think JD's in the same world. Apologize if I'm wrong. This is one that's been dead for a long time. That's Rob's launch indicator, a wealth signal, and an EMS all occurring like 4 days in a row. Good volume and a gap. Earnings are here, which is not yet. Relative strength and OBV look good. So let me talk about high-low jump on stocks that have been in downtrends and gone sideways forever. Ignore it. Does that look like an extended stock? No. Then don't care about the number. Now let's go and let's look at the market as a whole. And we'll use my combo list, which are some of the better stocks curated. So a lot of these had earnings. Autoliv, probably not too far to chase, especially that it closed in the middle of the range. It's at 59 in the high-low, relative strength OBV. So volume, breakout, momentum has 4 dots there, only 3 dots here because it closed in the lower half. Autoliv, CPRT is another similar stock. Similar setup without having the big move on Friday. That one looked interesting as well. Datadog, I believe, had earnings. Maybe not. All right. What happened with Datadog? Maintains buy at 152. So it had upgrades. But Datadog had a move up, had the well signal the day before. It's such an early signal. I like it. Volume, breakout, momentum, not extended. Relative strength and OBV look good. Google, we talked about before. What do you do at Google now? You know it's going to be at 100. It's hard for me to chase something after a move like that. I mean, if the market continues going higher and higher, I may regret not chasing it. But I always worry that these things are going to fade a little bit before they go higher. So it's worth watching. LHX saw a lot of interesting patterns on defense plays. I think they had earnings. They did here. 5% beat. Makes my life so much easier by having this back here. Thank you, Rob and Wealth Charts for putting it back. Big move here. Not extended. Relative strength and OBV look good. Look, to me, the point of having scanners is to design the type of stock you want to buy. And I like pullbacks in an uptrend and catch them when they're breaking out, and then create a tool to make your life easy. I have a buy watch list that I put together. Some of them will show up here. Let me see if any of them had signals. And I don't like buying things that are way extended. I could tell you, you probably can tell that from listening to me. So I looked at ALV, Datadog, Google. Tudor Peroni, this is a industrial, I think it's construction. I love the close, gap up. Yes, it's at 100, which is bothersome. Love the volume. Relative strength and OBV. Certainly, this is a watch list, not a buy list. So I'm going to look for a little bit of fade and buy it when it breaks out again. Toast. These are the little things that people use at the restaurants now more and more to take your credit cards. I like the pattern. Pull back to the 50, moving up off the 50 with volume, breakout, momentum, not extended. Relative strength and OBV look good. Looked at AA and JD. Teradyne is kind of lumpy, jumpy, but here's a semiconductor stock. Our manufacturer's breaking out. Carrier, expensive. This is I think they are in the air conditioning space, but look at the big move it's coming her. Lots of volume over the last week. Look at all those green dots. Relative strength and OBV, not extended. Generac, I mean, this is hurricane season's coming in Florida. I wouldn't be buying it yet, but it's on my watch list so I don't forget it. There are a lot of other things on the watch list that did not show up there because they're not having signals. I fill up a list. It's about 50 stocks that will go into a real-time radar screen and trade station with my signals on it to see if anything happens during the day if I have a chance to look. Amazon's got earnings this week, so I probably wait and see. but I think Amazon is getting set up to have a move here. Earnings are this week. Let's wait and see. It's probably it's one of the positive uptrending FANG stocks sitting right on their 50. I put this here for my mini-me at work, Simon. Dr. Simon, going to get married this coming week in Costa Rica. They said it would never happen. He probably still is holding on to a firm. It's sitting at the 200, moved up, got earnings coming, I think, soon. It'd be interesting to watch it. That's why it's there. App loving. I love this stock. Nice little pullback. Probably an opportunity to get in here. Speaking of opportunities to get in, if you believe the Abercrombie and Finch story, break above 50 here would be interesting after a recent pullback. Notice the green dots coming in, relative strength and OBV. Uranium seems to be setting up several different stories. It's not broken out yet, but probably worth having on your watch list. That this is CCJ. Beautiful setup if the markets hold up and we don't roll over with all the news this week, as Costco sitting right at the 50 in a squeeze with breakout and momentum. If you want to find a gold stock, this isn't a cheap one, but it's one that seems to be working. Newmont Corp has just broken out. Thursday was the big day, a little inside bar on Friday, but look at Thursday. It had 4 dots. Gap, breakout, volume, momentum, not extended, great relative strength and OBV. NVIDIA, talk about a setup. My goodness. How good would it be to buy NVIDIA sitting off in the 50-day moving average? Well, you missed a little bit of it, but 2-3% above it. I love it. I mean, if you like NVIDIA and you think they're going to be the leader in AI, you're sitting on the 50, breakout momentum signal, recent squeeze, relative strength OBV look good and not extended. It's probably the best opportunity to buy NVIDIA we've had since maybe back here. Anything else that I thought was worth sharing with you? So the Moxie trader called me up not too long ago and asked me what I thought about Tandem. This is one that I made a lot of money on in the past. It's one of the highlights that I talk about when I do education. I have to give him credit. It does look like it's ready to roll, and it's had a nice little move over the last week or two. What worries me, it's in the same space as Dexcom, and Dexcom died on Friday. And you know why? Because hitting under here is the earnings, and they missed their earnings by 18%. God, I love having that back. Can you tell? All right, I'm losing my voice. So I think I've given you enough things that I like. Talked about the market. Don't forget the risk is here. I think there's more chance that we run up to the 20 or the 50 and fail and go down to lower lows. It doesn't mean it's impossible that we don't blow through them. I just think it's unlikely. I'll be traveling. I'll be out in Vegas if my cold allows me at a conference, and then I got a wedding to go to. But have a great week and lots of news, and talk to you soon. Thank you.